In an effort to make the banking sector resilient to NPA shocks, the RBI today told banks to set aside more provisions for even loans where interest is actually being paid, but where the company is showing signs of stress. Bank boards will now have to draw up policy for such extra provisioning. RBI added that the telecom sector in particular is showing stress and loans to these sectors must have higher provisions. Latha brings us more.
Yes, that's right. Under current rules, even for a standard loan where the borrower is paying back the money, banks have to keep 40 paise for every 100 rupee loan. That is 0.4% as provisioning. Now in sectors which are stressed, where say, like steel, real estate, power, especially gas-based power, the board will have to devise a policy where you provide more so that in future, if it becomes a bad loan, you already are buffered. This actually is required under Ind AS 9 and, that will become mandatory globally by April 2018. This is the preparation for that. Now, the board has to devise the policy. For telecom alone, RBI says that you will have to provide more because according to them, in that sector, already the earnings is not enough to pay the interest. What is the impact? Public sector banks have more loans to telecom, not so much private sector banks. The total banking sector's exposure is about 1.5%. That's not a great deal. But on overall stress, well, according to RBI, the SMA2 loans, as they are called, loans which have not been repaid or interest not paid up to 60 days, is about 4.5% to 5% of total loans. That much will have to be provided for, a little more. It is difficult to quantify the hit at this point in time, but because of this, there will be a negative impact on the banks.